Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. The S&P 500 has been on an incredible move recently. From its bottom right here in October, we've seen an 11% move up on the market. Quite an extraordinary move when you think about the fact that 10% is the annual average return of the S&P 500. These are massive, volatile moves that we're seeing on the market. So the question on everybody's minds right now is whether or not this is sustainable, whether or not we should actually expect this to last. We've seen many rallies throughout 2022 in March and May, throughout the summer. All of these failed at one point and failed to continue and failed to bring the market into enough momentum to get back up to the all-time high. So is this just another one of those rallies? We're going to take a look at that in detail in this video. What are the differences? What are the similarities from a technical standpoint? And also all of these turning points. What triggered the reversals of these rallies and whether or not we're actually seeing signs of that today. Of course, we talk about these developments multiple times a week on this channel. Our aim is to inform, educate, and help investors navigate their way through the financial markets. So if you are interested in following these crazy markets with us, don't forget to smash that subscribe button. And now without further ado, let's get right into it. So the S&P here, as I said at the beginning of the video, has been on a 10%, quite a powerful rally here. Now coming into this trend line resistance here, and the RSI is coming into closer at least to the overbought zone here. So is this the end? Is this where the markets reverse? But when you see this type of move, I think it's always important as an investor to understand what signals worked, what signals didn't work to predict this move. And if we go back to an S&P 500 tactical update that we posted here on the 10th of October, we can quickly see right here that the S&P 500 breadth, so this is the percentage of stocks trending above their 50-day moving average, reached an extremely oversold reading. Now back here, we were talking about capitulation in the market. Many people disagreed with that, and that was completely fair, right? The VIX, it didn't really look like capitulation, right? This really wasn't, from a price action standpoint, a massive capitulation event. The VIX didn't go parabolic right here like it did in March of 2020 or previous capitulation move downs like 2018 right here or 2015 right here where you really saw volatility spike as market participants panicked. That's not what we got on this recent low, but we did get this indicator here of the breadth flashing a capitulation signal that really is only seen at very important market bottoms. And that was 2003 at the bottom of the bear market. You never saw this reading throughout the entire bear market. In 2008, let's zoom in here, after the big collapse in the market. So this was around in October. So definitely more downside before the market's bottom. It signaled the beginning of the bottoming process. In 2011, that was the bottom, 2015 bottom, 2018 bottom, and then a few readings here. Of course, a very special moment in the market during the COVID panic. And interestingly, we got that same reading right here at the bottom in October of 2022. And the same reading we got back in June. And we highlighted this development in quite a few different articles, this one as well. S&P 500 breadth was showing capitulation, and at the same time we got a massive 2-day rally on the S&P 500. This is a chart that I found very interesting as the market was falling right here, because we got this 2-day move here. This indicator right there is the rate of change, so it oscillates up and down in function of what's been happening over the past 2 days of trading. And we got this incredible, very powerful rally there off the low, right after that capitulation move down, that if you look at how many times we actually got that in 2020, we got it in 2018, 2015, and a few times again in 2008. So generally, nothing can guarantee you that the bottom is in, but it spoke to the odds of accumulating evidence that a bottom was in the process of forming. So, personally, I don't take credit for that. The data is there for us to see. The charts are easy to follow if you know where to look. And that's what we try and do in gameoftrades.net, is give you guys regular updates on the market, showing you the important charts and in which direction the general market environment is heading in. So those were signals that in hindsight we know were successful at timing that bottom. But are we about to see a reversal here as we hit that line of resistance, or at least as we reach that line of resistance right there corresponding to that August high and that September high. I think this is a level a lot of people are watching, because you also see right here, if you put a horizontal line at around 3,900 points, that's a very significant horizontal level with lots and lots of reactions right here. So definitely something a lot of people are watching here. When a lot of resistance coincides, that tells you it's an important obstacle for the S&P 500. Now, if we jump back to one of our more recent updates on the S&P 500, we highlighted a couple of different things that I think were very interesting. So first of all, this was the technical setup we posted right here. We had a nice breakout of this wedge. We had a very important level to watch out for at 3,587 points, and important targets to look at on the S&P 500. And we're hitting that first target zone as we speak. But if we scroll down, one of the key warning signals that we were watching in this article, and that we're currently watching very carefully, is the divergence between stocks and bonds. You can see this is the S&P 500 in blue, and this is the inverted 10-year yield in orange. Now, I put up a few examples of moments where the S&P 500 rallied without the 10-year yield confirming that move. March of 2022 was an example here. Market rallying, yields not confirming. August of 2022, great example as well. Market rallying, yields going in the opposite direction. And May, right there, was a good example. Market making a higher high here in May as yields are completely moving in the opposite direction. And so this was one of those warning signals that we were saying, okay, this initial thrust, we've gotten a few very promising signals on the S&P 500, but the intermarket confirmation of this rally really comes when the 10-year yield confirms the move on the S&P 500. Without the bond market confirming the move on stocks, it's difficult to imagine that this S&P 500 rally could be sustainable, right? I think this move we're seeing on the S&P is strong, it's promising. It has very little chance of succeeding in the short term without yields, that chart on yields, actually confirming that move. So you can see I've put that same chart again here, and you can see we did have initially some divergence right there, and right now we're seeing yields reverse and potentially come back up. This, I think, is probably the most important thing to watch right now. If you continue to see yields move in this direction, that is confirmation. That's good news. As long as that happens, you're going to see the S&P continue to rally, encounter this line of resistance, and potentially head on much, much higher as we get the Fed to step back, as we get closer and closer to that point where inflation begins to break down. Now, some people think inflation's not going to break down. We're in the camp that thinks inflation has run its course and it's going to reverse back down, and the market begins to really price in the Fed slowing their hiking cycle, even potentially pausing their hiking cycle, which they briefly touched upon over the last few weeks, although it's very preliminary evidence for now. But so let's take a look at that chart of the 10-year yield, which I think is incredibly important from a technical standpoint, which I think is incredibly important at confirming or invalidating the market rally. And you can see I've got a nice trend line here that seems, as I'm making this video, to be at least trying to break down. So this is an important line to watch as well. We'll be watching that very carefully on gameoftrades.net. If we see a real breakdown on the 10-year yield, there's no reason for us to suspect that this rally should be short-lived and should fail anytime soon. If we scroll down to this chart here, you can see what development we recently had on the 10-year yield. Very interesting, fading momentum, right? So as we were making that new high on the 10-year yield, look at the RSI. It's showing momentum is moving down. It's pulling back. Every time we've had that, now it didn't necessarily cause a crash in yields, at the very least a consolidation, a pullback, or even a larger consolidation, right? And so we went out on a limb and said, if the 10-year yield is slowing down in momentum, we shouldn't see a massive move down in the stock market here. A lot of people were calling for the market to break down and to see another 10-15% drop. For that to have happened, it would have required the government bond yields, the 10-year yield, to skyrocket. And technicals were not confirming that. Macro was not confirming that. The Fed that week was in fact discussing for the first time since, I believe, July, the idea of potentially pausing at one point. So it really didn't favor the idea that downside momentum on the stock market should be accelerating. And so far, it seems these divergences are playing out. Now, again, yes, it's quite promising, and I can give you an alternative trend line here, right there. If I use this low here and this low here, you can see we're testing that here and potentially breaking down. If that continues, watch out for S&P 500 upside, right? If we see a breakdown in bond yields, that, in my opinion, would be a sure way to continue seeing upside on the market. That, in my opinion, would be confirmation of more upside on the stock market, potentially getting into our next targets. But of course, we'll be updating you guys every step of the way if we see any changes in these dynamics that we're looking at very carefully. If you want to follow these updates with us every step of the way, and also have access to the actual model portfolio allocation percentages we have on different assets, and also our watch list where we have specific targets for all the key assets that we actively update on the website. So if I have to make a conclusion, the S&P 500 is coming into some pretty big resistance, starting to get into the overbought range as we get this trend line resistance, this horizontal resistance, and we're up already 11% off the low. So this is the moment where for the S&P 500 to continue higher, we really need the macro to follow. For now, it's a nice technical balance. It's a retracement of this move. That's nice, but it can't go further without actually having a confirmation from the bond market and also junk bonds that are a key intermarket tool that we've been using. This is a very important trend line to watch as well. A left shoulder, a head, a right shoulder. If we break out above this, that is the financial markets, the corporate bond market, essentially confirming this move on the S&P 500. So I hope you guys enjoyed this episode. If you did, don't forget to smash that like button as hard as you can. And also, don't forget to subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.